This is your tech news briefing for Wednesday, October 26th. I'm Zoe Thomas for the Wall Street Journal. The prospect of a recession has a lot of executives understandably nervous. But the president and co-founder of the ride-hailing company Lyft, John Zimmer, says he sees an opportunity. His take may seem a little surprising, seeing as the company's share price is down more than 80% since its initial public offering in 2019. At the Wall Street Journal's Tech Live conference this week, WSJ business editor Jamie Heller spoke with Zimmer about the ride-hailing sector and Lyft's foray into autonomous driving. She started the conversation by showing a slide of the stock's decline. Here are highlights.
John, thanks so much for being here. Since you guys went public, it's been quite a rough ride.
Yep.
Yeah.
Felt that.
So it doesn't seem like Wall Street's quite liking it as much as some of your customers are. So maybe you could just talk about what you think just justifies that disconnect.
Sure. So Lyft's been around for 10 years now, and we've had a profound impact. If you look on the rider side, we've done over 3 billion rides on the platform. 34% of the US population has taken a Lyft ride since our beginning. 3% of the US workforce has earned money on the Lyft platform. And as we move towards an autonomous future, what we're doing is critical to building out that transportation of the future. So obviously, yes, it's been rocky.
I know you're on risky ground talking about the autonomous future, but we'll get to that.
Sure. But of course, we've faced many challenges from the beginning. First was the regulatory challenges, then the competition with Uber. Uber had raised $3 billion from the Saudi government at a point when we had 5 months of cash left. And then we went public first, then got hit with a pandemic that took out 70 to 80% of our volume almost overnight. And so that was a big impact on the stock. We had a cost structure that was based on, we were about to get to profitability on a business that was 4 times bigger than what it got shrunk to in the pandemic. And now we've ticked our way back up, gotten to profitability, and I'm confident as we get through these recessionary pressures that Wall Street will fix the shape of that chart.
And meanwhile, you're going into a potentially tougher economic environment, which you guys have already been wrestling with.
Yeah, a lot of tech companies at the start of the pandemic had a great ride, whether it was Zoom or Google or others. The pandemic meant a lot of people working inside and using their products. That was not the case for us. And so I would say what's coming is actually maybe the third or fourth hardest thing we've faced in terms of the coming potential recession or the recession that we're already in. So we're ready. We have a strong team. And frankly, with a two-sided marketplace, on the driver side, typically there are more drivers looking for work in a recession.
But what about on the demand side? I mean, how are you seing higher inflation?
If you look back at inflation affects us mostly on insurance. If you look back,
which you've added a fee for now, right?
Our service fee has gone up related to insurance. If you look back at recessions and you look at transportation, ground transportation specifically, it stays pretty static. So perhaps growth slows down in a recession, but people need to get around. And so I'm less concerned, than if I was to knock on our competitor, in the food delivery business in a recession, getting a $30 salad is probably going to be less likely someone does in a recession than in a pandemic.
But just coming back to Wall Street, and if you look back at this chart, I mean, the market
looking at it. Thank you.
The market's seeming a lot more confident in Uber's more diversified model.
Yeah, I mean, let's talk about what I was just saying is if you go back to the pandemic and you say, hey, we have a business that delivers food to people's homes when they're not going out. That seems like a really good idea in a pandemic and did really well. And it's a real business. It's long-term, there'll be a business of some sort. But we've always focused on the long term. We always believe that transportation itself is the largest. If you think about this, whether it's a 3-year, 5-year, 10-year period, if you think about the opportunity we have in front of us to affect $1 trillion of annual spend, that's how much is spent on transportation every year. It's the second highest household expense. The only thing Americans spend more money on is the house itself. And Americans spend or use their car 4% of the time. We have barely scratched the surface of what we can do as a business to impact and improve transportation and save people money.
So coming back to autonomous cars, this stage and many other places have been the sites of many grand predictions about autonomous cars that haven't come true, including one from you that they would become account for the majority of Lyft rides within 5 years. That was 2016. So how much do you think that kind of thing has been a pressure on not just your stock, but Uber, Tesla also? Like, how much was there high hopes for the AVs with all these predictions built into their expectations?
I don't believe in talking to investors, I don't believe we've actually really been given value previously or recently, less or more, for the critical role we play in the autonomous transition. I do think that there was broadly in the tech world and maybe financial world, there's been kind of non-belief, excitement, non-belief kind of back and forth over the last 5 or so years. My opinion is it is not a matter of if this technology comes to market, but when. And I'm highly confident that when it comes to market, it will need to happen on an existing transportation network. The idea is we're going to have a hybrid network where the far majority of rides for a very long time will be with, because I was wrong, will be with human drivers. But over time, let's say 10% of rides happen with an autonomous vehicle in 3 years. That's not a prediction, that's just hypothetical. And in 3 years, 10% then goes, 3 years after that goes to 20%. You'll always, as a customer, want to be on a network where you can always get a ride.
I'm going to have to pause you because my clock is up. Thank you so much.
Thank you.
And that's it for today's Tech News Briefing. For more coverage of this year's Tech Live conference, visit our website, WSJ.com. I'm Zoe Thomas for the Wall Street Journal. Thanks for listening.